If you're between the ages of 55 and 60 and you're thinking about retiring early, if you're not careful, taxes and penalties could eat away at your retirement savings. You see, many retirees who have saved seven figures or more face unexpected cost when accessing their retirement savings before 59 and a half. So in this video today, what we're going to do is we're going to share strategies to help you avoid those penalties and keep more of your money. Now, for those of you new to the channel, I'm Scott Searns. I run a retirement planning and investment management firm where we help people retire and maximize their retirement story. So first, we're going to talk about the basics of where these taxes and penalties come from. Then we're going to talk about the exceptions to the rules, strategies. Then next after that, strategies of how you can help avoid the taxes and penalties. And then last, I'm going to walk you through a client story of how we helped somebody at age 55 use these strategies to retire and potentially reduce their long-term taxes that they're going to pay to the IRS. So let's start with where the taxes and penalties come from. If you have your money in a IRA, 401k, 403b, 457, simple, SEP IRA, I think we tackled them all there. If you have your money in one of those accounts, which are considered tax-deferred accounts or retirement savings accounts, any money that you withdraw prior to age 59 and a half is subject to a 10% early withdrawal penalty. Now, there are some exceptions to the rules. We're going to talk about those, but just know, have that common conception in your mind that taking out money prior to age 59 and a half, you're going to face a 10% penalty. The tax part comes from any money that's in a tax-deferred account. All of those accounts that I had mentioned earlier are also subject to income tax at your ordinary income tax rate. Now, I know some common misconceptions which you might already be thinking. First off, it's your money. Why are you subject to tax? Or, well, if you're retired, you should be able to have access to your money penalty-free. Or maybe you're thinking, well, you know what? I've got this Roth money over here. I'm just going to use the Roth money because I've heard that is tax-free. You see, all of these common thoughts could be potentially leading you down the path of penalty. And so we don't want you to be paying an extra 10% on your money if you're retiring between 55 and 60 or any time before age 59 and a half. So it's very important then that you know the exceptions to the rules, as well as some common strategies that we utilize to help people retire early so that they don't face these penalties and they can have access to their money to live the retirement lifestyle that they want to live. So to access your money without penalty, you need to know the exceptions to the rules. The first exception, using the rule of 72T. What this is taking substantially equal periodic payments for a period of at least 5 years. Now, and it could potentially be longer than 5 years as well, depending on when you retired. This is one where I'm going to say make sure you're working with a financial professional, working with a tax professional, because there's a lot of guidelines within this that you have to follow. But if you follow all those guidelines, then you are able to take money out of your IRA penalty-free prior to age 59 and a half. Now, the second exception to the 10% early withdrawal, the 10% penalty for early withdrawals is the rule of 55. The rule of 55 states that you are able to make withdrawals from your current employer's 401k, the employer that you most recently left, as long as you're age 55 or older, penalty free. Again, don't have to pay that 10% penalty. Now, there's a couple stories I want to share with you here. Yes, the rule of 55 exists, and two totally different stories, two totally different scenarios. One scenario with the client when we called their plan provider to talk about the rule of 55 and understand and make sure that they would be able to take monthly or annual payments from their current 401k, the provider said, yeah, that would be no problem, and they could set up monthly periodic payments from their current 401k. However, another story, two people, age 55, just different 401k plans, The second story here, the client had one option. He could utilize the rule of 55. He could avoid the 10% penalty, but in their plan, they required all of the money to be taken out in one lump sum. He was not able to take periodic payments from age 55 to age 59 and a half like the other client was able to. So yes, the rule of 55 exists, but just make sure that you call your plan provider and see how they apply it to your specific plan. Will you be able to take payments out from 55 to 59 and a half as you need to, or are they going to make you take payments out in one lump sum? So very important. The last, I'll say, exception to the rule, but I don't know if I really favor this exception, is using your Roth IRA contributions. You see, contributions, not earnings, but contributions are tax and penalty free at any point in time as long as you've met the 5-year rule. Now, here's the thing with Roth IRA contributions. A Roth grows tax free. Gosh, I mean, if you need to use your Roth from 55 to 59 and a half, the base amount, the contributions that you put in, okay, but man, you'd really want that money growing tax-free for your future so you can use it, in your 60s, 70s, 80s when tax rates are going up. You've got all that tax-free money to utilize. But depending on your specific plan and your tax plan, it may work out. All of these, Roth, utilizing your Roth money. And if it's Roth conversions, that has separate 5-year rules than Roth contributions, understanding the 5-year rules. The rule of 55, that applies to your current 401k. But if you have past 401ks sitting out there, it does not apply to those past 401ks if you've left them at the previous companies and then never rolled them over to your current 401k. The rule of 55 doesn't apply to IRAs. Again, only to your current 401k. And so there's a lot of, rules to all of these exceptions, and you've got to make sure that you understand those rules as you go through this. So those are the exceptions to the rules that you could potentially utilize to access your money penalty free. Then there's strategies that you want to potentially put together. So if you know that you're going to potentially be able to retire prior to age 59 and a half, well, one of the things that you might want to consider doing is actually saving money into a brokerage account or a non-retirement investment account. It's kind of building that bridge until you do reach age 59 and a half. You see, a non-retirement account, you have access to that at any point in time. So you might hear it called a brokerage account, a non-qualified account, a non-retirement investment account, a joint account, a trust account, an individual account, all of those different names. But basically, it's the ability to save, the ability to invest, but you have access to that money at any point in time. Another strategy that you might want to utilize is that if your company has a high deductible health plan and you have an HSA available to you, is contributing to that health savings account. That's money where you're going to get the tax deduction. It's going to grow tax-free. And you can use it at any point in time tax-free for qualified medical expenses. So is this going to cover all of your expenses between 55 and 59 and a half? No, absolutely not. But what it is going to do is it's going to mean that's less money that you have to pull out of your IRA, or less money that you pull out of your 401k, less money that you're pulling out of these other accounts to be able to pay for medical expenses or health insurance, which is unfortunately pretty costly if you are retiring early. So those are some strategies that you want to think about utilizing if you do plan to retire before age 59 and a half. So last, I just want to walk you through a story of how we put all of this to use to help somebody retire prior to age 59 and a half, actually retire at age 55. We're just going to call this person John. Now, John had a large amount of money in their current company 401k, primarily over 7 figures that they had saved up into their 401k. Now, John had enough saved up to be able to retire at age 55. However, John had so much saved up in the 401k that we're also worried about future taxes, meaning when John reached, age 70, that the taxes, because of the required minimum distributions, would push them into a higher tax bracket in the future than where they would be if they're retiring at age 55. So there was some tax planning thoughts going on with John, as well as that John just basically wanted to retire, could afford to retire, but needed to access money to live John's life and their family life. John also had a brokerage account, so that non-retirement investment account, but not enough necessarily in there to help John bridge the gap from all the way from age 55 to 59 and a half, meaning John couldn't just live on that brokerage account, and John and his family couldn't live on that brokerage account. If so, that brokerage account would run out before they got to age 59 and a half. So they were going to need to access their 401k money. Now, all of the money in John's 401k was at John's current employer. John retired after the age of 55. So one of the first things that we did is we called the employer-sponsored plan to fully understand that plan. Now, the plan actually allows for a couple things. One, it allows for partial rollovers. The reason why I'm talking about that is more from a tax planning aspect. If we can get some of that money out into an IRA, there is the ability then to start doing Roth conversions while John and his family are in lower tax brackets. I'm going to talk about that in a second. The other thing that we discussed with the provider is that they do, of course, allow John to use the rule of 55, and John could set up periodic payments from 55 to 59 and a half and take money out of that 401k without the 10% penalty, utilizing the rule of 55. But the money didn't have to come out like in one lump sum, like that story I was using earlier. So John would be able to take money out each and every month, every quarter, every year, could do whatever he so choose. Now, one thing that we did find out as well as part of John's plan is that if they were to make miscellaneous withdrawals, just to say, I need 20,000 or I need 15,000. They could only do that twice a year. However, if John was to set up payment system, that could happen and they could make adjustments to that as they go. So that was good to know, because if they took 2 periodic payments, that was it for the year. They couldn't do any more. Otherwise, they would face penalty based on their specific plan. So you can see how important it was to understand all of the aspects of their plan, so that way we could put all the parts and pieces together. So one, we've got John's plan, being able to provide John with income from 55 to 59 and a half, penalty free. But since it's coming from a 401k, as you already know, they will pay ordinary income tax on those dollars. The next part is we were able to do a partial rollover into an IRA. Why was that important? Because we wanted to do Roth conversions. Because of the amount that they had saved up, multiple millions in their accounts, they would be in a higher tax bracket in their future because of the required minimum distributions. We wanted to start converting that money at lower tax brackets over to Roth IRAs. Does that make sense for everybody? It all depends on your plan and your situation. So we got that money over into the IRA to do Roth conversions. Issue is that if you do a Roth conversion, you have to be able to pay the tax from a non-IRA account, because if you're doing a Roth conversion prior to 59 and a half and you try to withhold the tax from the conversion, you're going to face the 10% penalty on the tax that you're withholding from the conversion. So that's why we've got the brokerage account to be able to pay the tax on the Roth conversion, and the 401k for John to live to fund the lifestyle needs for their family. So there you go. You can see how there's a lot of parts and pieces going on when retiring prior to age 59 and a half to help not only avoid penalties, but especially if you're going to, implement strategies to help reduce your long-term taxes. So I hope that you found this video to be of value and benefit when it comes to planning for your retirement. If so, subscribe to our YouTube channel, as we're coming out with new videos each and every week on topics like how to help reduce the taxes on your IRAs, 401ks, 403bs, 457s, topics on Social Security, as well as other retirement topics. So subscribe, that way you get notified when the new videos come out. Thanks. Have a great day.